You're watching Captains of Industry here on CNBC Africa, and I'm chatting to Colin Coleman, the Managing Director of Goldman Sachs, sub-Saharan Africa. Colin, let's start with your views on the South African economy. You spend a lot of time with the international community, telling them about what is going on in this country and the rest of Africa, which we'll come to in a moment. Let's start with South Africa and what you are saying to international clients.
There are obviously a lot of clouds, dark clouds, around emerging markets in general, including Russia, Brazil, Turkey, and South Africa would be part of that. In some ways, actually, South Africa looks better. How does it look better?
Well, this is good news for us.
Well, it's partly good news. It looks better because we have well-governed companies, very strong management teams. We have a sub-Saharan Africa growth which is lower because of the oil price and commodity price fall around 1%, so it's growing at 4.5% at the moment. But we have a good neighborhood in general terms. We can talk about that. But due to those factors, and South Africa growing at 2%, not at negative percent rates like Brazil and Russia, we actually stand out as places that international investors can still invest in companies that are liquid, well managed, well governed, and still have quite resilient in terms of earnings growth. However, the negative side and the storm clouds are both about the macro issues around commodities, China, around the coming rates cycle in the United States, meaning...
So let's unpack these one by one. Let's start with the macroeconomic environment and the commodity cycle, where we are right now and what implications that has for our economy.
Well, it's got huge implications. Both the sucking into the United States of capital as interest rates rise and sucking out of the emerging markets, at the same time as commodities are under huge pressure and will likely sustain these levels into the next 12 months, in broad terms, is our forecasts. This will mean that the value we get for our exports of commodities will have significant pressure on the commodity end, perhaps assisted by a falling and depreciating currency. So the net effect is that our twin deficits are going to be under pressure, our fiscal deficit and our trade deficit, as our export values come under pressure, also because of productivity problems, labor problems, and our ability to get these goods into the world markets.
So you mentioned labor problems. With the pressure on commodity prices, does this mean the end of our mining sector? Or is that dramatic?
There's certainly signals out there. Mark Bristow was quoted as saying the gold mining industry is quote-unquote toast, and there are panic signals and warning signals coming from the government in regards to the whole mining sector being in trouble, quote-unquote. But this is a very serious situation because the financialization of the GDP income into South Africa over the last 20 years has effectively reflected the falling contribution of mining and manufacturing, which used to be around the mid-80s, around 35%, has fallen to more like 20% these days. And it's been made up by the growth in the financial sector, the real estate sector, the tourism sector, which is now under a bit of pressure due to visa regulations. And so these factors mean that there has to be a support to what used to be a financial growth off the back of a mining and manufacturing base.
It pretty much sounds like the bottom has fallen out of our economy, listening to your description.
I wouldn't put it this way, but there certainly are warning signals that the economy is in structural difficulties and we have to address them. It means we have to fix the mining sector. We can't beat our mining companies over the head with licensing and empowerment and other issues that make it more difficult when you're in ICU to recover, number one. Number two, we have to support the industrialization and manufacturing sectors. And I think that there are attempts to have a dialogue, which I've been part of, in regards to facilitating a better understanding between private sector, the IDC, and the government as a whole.
Isn't the time for dialogue over? If we don't see action very quickly?
No, I would take the other point of view, which I think there's no better time for dialogue than now, because we absolutely have to take action. It's definitely, if you're saying it's a time for less talk and more action, yes, but we have to have the talk in order to have the action. So
you feel we're on the right path to some kind of stability?
I think an element of pressure, let's not call it crisis yet, we'll come back to that because there's some panic about a looming crisis, which I think is unfounded. But the warning signs have to be acted upon.
What would you deem a crisis? When does it get to crisis stage?
When you look at crisis countries, and we've done a recent analysis about crisis, you look at Greece, Latin America, Southeast Asia, and you see certain conditions pertaining. The warning lights from our side are the twin deficits and the very high unemployment rate, the 26-25% narrow band unemployment rate, 35% broad unemployment rate. Those are our concerns. We still have a very deep financial sector, strongly capitalized banks, and we have still growth, and we have relatively low inflation. So I would say we're in the middle of the pack when compared against crisis countries. When you look at the good signals, and we've tested against shocks. So we've actually run stress tests of what happens when portfolio flows stop. That's called the sudden stop. So institutional investors from offshore no longer buy equities and bonds, but they retain what they have. We've looked at Arab Spring type crisis, where you have social unrest, which obviously lots of people are worried about given this high unemployment. And we've looked at an unprecedented Armageddon. An unprecedented Armageddon.
This sounds very bad.
Is both the portfolio flows stop and they sell everything that they have.
So what happens?
That's never happened in the world ever. So the sudden stop is actually sort of the base case of crisis. You asked what is the crisis. The base case is when the portfolio flows stop because there's some measure of perceived crisis, and therefore, which is not happening in South Africa.
Where foreign investors no longer believe in the South African story.
Right now we have net buying of equities, and we have a net buying of bonds by offshore investors into South Africa. So what happens in those three cases is in the sudden stop, we actually have somewhere like 30 months of reserves in order to deal with that situation. In the social crisis unrest scenario, the Arab Spring, we have about 18 months. And in the Armageddon, which again has never happened, we have about 6 months before we have to get an IMF program. So actually, when you look at these things which we've looked at in detail with data, it tells you that South Africa is very resilient for 3 reasons to crisis. 3 reasons are: we have deep financial markets where the domestic capital markets can absorb local foreign selling, number 1. Number 2, we have very low levels of foreign currency denominated, hard currency denominated debt by the government sector. It's about $10 billion, which is very low by comparison with countries like Turkey. And thirdly, we have a very resilient corporate sector. So as a combination of all of those factors, and we have a floating currency, which is not the case with many of these crisis countries where they had pegged currencies, we're actually quite resilient to absorbing this crisis. But the message should not be,
we're going to be okay.
The message should not be we need to be complacent. The message has to be we need to use this time to fix our country and fix manufacturing, fix mining, fix our labor, fix our state-owned enterprises.
Fix electricity.
Stop corruption, build the infrastructure, really come to terms with what's needed to be efficient. And so we're spending a lot of money on the public sector and on people, education, health. We're not getting the returns on it, and we need to actually get quite disciplined as a country and productive as a country.
So let's talk about Eskom, because I think we have to find a starting point. Let's just make Eskom, for the sake of our conversation today, the starting point. What is the solution?
Well, Eskom, I think, has projected that it has a plan. It has a plan for load shedding and for maintenance management, and it has a financing plan. Time will tell whether that plan is resilient and robust enough. Many people have questions about whether the capital expenditure has been sufficiently provided for, whether there is sufficient depth of maintenance, that the fleet won't, you know, when you're driving the car and the car stops suddenly and you didn't anticipate
well, that's it. No,
rather than
that's
putting
this,
it
you
in.
must have done that stress testing, because if we use that scenario where the car stops and you can't start it again because it takes a hell of a lot of back-end work to reignite those engines, and this is, again, now we're talking about Eskom. What happens if that scenario comes to fruition? Because having listened to a number of the experts on news channels and radio stations, it's not out of the realm of probability that Eskom falls over and we can't start it for a couple of months.
Well, what I understand, and that's for Brian Molefe and them to articulate, but I understand that they have a plan that if there's signals of failure, they themselves will bring that system, they will manage the system in that way rather than allowing it to fail. Because if they allow it to fail, it will take weeks to restart, whereas if they manage the situation and they have to close some plants off, then they can restart those plants quicker. But the damage of it to the economy is massive. So look, I've obviously great sympathy for somebody like Brian going into Eskom and having to fix a problem that wasn't of his personal creation. And we all wish the Eskom process gets fixed well. But generally speaking, I would say we have to get the competent people into the boards of companies, into the strategic positions in these institutions, the CEO, the CFO. We have to allow them to do their jobs. They have to take the right corrective measures. And this is for Petro SA, South African Airways, for Eskom, for Transnet, for all of these companies. And
so
we
all
cannot,
the state-owned enterprises.
and we cannot have, and particularly what I call the systemically important state-owned enterprises that have knock-on effects everywhere in the economy, like Transnet and Eskom. We cannot allow to have political interference or feeding at the trough of effectively what is a corrupt practice. Yeah.
Colin, when you travel internationally and you engage with potential foreign direct investors, how do they perceive South Africa right now? You've given us a scenario on the ground.
I would put it bluntly that South Africa is not on the radar. It's off the world map for many people, other than the institutional investors that have to invest in emerging markets, that are looking for companies with good, solid stories. And that's why we are getting the attention we do from the likes of the Wellingtons and the Fidelities and those very large, deep institutional investors that are invested in many companies.
Let's talk about the rest of Africa now. And again, it's a big place, so let's not paint the whole of Africa with one brush. Let's start with Nigeria, because that's also been a key concern point, in that we have a new president, we don't have a new cabinet, and in many instances, people who are operating on the ground in Nigeria say that the economy is at a standstill because there are no decision makers. That can't be a good place to be.
Let me just say, at the outset, I'll address Nigeria. Africa in general still occupies a special sort of position at the moment, because it's seen to be the last frontier of growth. And the demographic pool of Africa growing to 2 billion people, doubling its population in the next 30 years, is, you know, a very significant factor on the world stage. It's getting a lot of attention, and yes, commodity prices have slowed growth in Africa, but it's still 4.5% is significant. So coming off a low growth or a low base, there is significant growth to go. Nigeria is critical because we were all extremely happy with the peaceful transition in what looked like it could have been a violent conflict and turbulent election, which turned out very well. The uncertainty and the sort of long-term sort of transition that has taken place has caused a lot of concern. And meanwhile, particularly things like the economic policy and the issues on the Naira have caused a lot of concern. And this is also causing sort of the engine to stutter. And you feel that and talking to many corporates who are active in Nigeria, they sense it and they feel it, and they're
the
projecting.
Same thing. The economy has almost come to a halt right now.
Yes, I wouldn't say it's come to a halt, but it's stuttering, and there's not that momentum that there was. And so I think it's very important that President Buhari does make his decisions. I know he's got lots of difficulties in getting that done expeditiously, because he's being very careful about not putting people of compromised position in place. But what he's doing so far has been quite interesting. He's basically taking all the people he deems to have not been colored with corruption and putting them into the military. He is systematically trying to win over partners like the United States and France to his campaign. He has replaced the NNPC board completely and put a private sector person from Mobil into the CEO position. So far those appointments look like they are very thoughtful, very conscious, very much anti-corruption sort of as the trend. And we just have to see how he completes this campaign. And one hears a lot of stories about the President Goodluck Jonathan administration being tackled on corruption charges. So it feels like there's going to be a very significant period of questioning of the past and planning for the future in Nigeria that will make it a very turbulent place for some time. But hopefully,
it should be positive for business if you rule out corruption.
Absolutely. I mean, change is painful, and you can't expect Nigeria to change without pain. But at the same time, if they do the right things, that country has real potential.
But it's a little wait and see right now.
Right now, the jury's out.
Ghana, being another big economy in West Africa, they've also had inflation problems, currency issues. Do you hear anything about the Ghanaian economy itself, and that could be the bright spot in West Africa?
No, I don't think so. The macroeconomic situation in Ghana is very concerning, and they have to get their fiscal and monetary situation far clearer. I think, and it's a small economy, but it's in the past had very talented people and so on. So hopefully that will correct itself.
Again, it's going to take time. This is not an overnight fix.
Yes. I mean, I think there are lots of troubled sort of stories. Kenya in and of itself, I saw the Auditor General's report that 1% of the state expenditure could be deemed clean in Kenya. That was the Kenyan Auditor General's report, meaning 99% couldn't be, which is an astounding statistic. Having said that, the whole of East Africa, from Mozambique, Kenya, Uganda, Rwanda, Tanzania, right up to Ethiopia, is undergoing a complete renaissance. The oil and gas finds are extremely exciting. There is a huge amount of attention on that. There's a lot of private equity activity going on, a lot of sovereign wealth fund and national oil company interest in that. And so that whole East Africa story is actually becoming a quite significant story. It used to be largely irrelevant before the oil and gas story arose.
You know, we've been drumming on about West Africa, Nigeria for so long. Maybe now the narrative is changing. And as you are saying, it's going to be East Africa coming back to the fore in a big way.
Well, I think it's definitely a more portfolio story. Just if you take North Africa as an example, you know, President El-Sisi, who's had you know, a different sort of perspective on what to do there, is definitely driving an economic reform program. And they've just opened the second Suez Canal recently, which is a very significant project they were talking about only in February when I was at President El-Sisi's investment conference. So the fact that they're executing on that program of economic development and infrastructure so quickly is quite encouraging. Obviously, the politics of North Africa is concerning. Morocco is an interesting place. So I think you're getting much more of a portfolio effect. We're seeing it in our business. So we're quite active across all of these countries we've just mentioned. including Angola, including East Africa, West Africa,
I want to chat
and
about
North
Ethiopia
Africa.
in a little more detail because, again, when you say Africa being the last frontier, that's why we still have place in the global investment portfolios. Ethiopia could be the jewel in Africa's crown that is about to become very,
well, I was
very
very impressive.
profitable.
There's 100 million people. They've been growing at 10% growth off a low base for 10 years. I was very impressed. I met with the President's economic advisor, heard his plans. They sound very similar, by the way, to some of South Africa's industrialization hopes, except they're much more advanced. They're building industrial parks. They are, definitely being very conscious about what sectors they're going to open up and what sectors they aren't. The sectors they are opening up are designed to generate cash for building infrastructure like trains, power stations and so on, which are in place. And the sectors they're not opening up are consciously attempts to keep the cash in the state so that they can afford to fund those, including the telecom sector and the retail sector and the banking sector. But I think eventually they'll open those. I don't know when, maybe it'll be a 10-year program to open those sectors. But when that all happens and they're being very conscious and centralized in the way that they're thinking about it, but as they do more, hopefully they'll get more confidence to open things quickly.
Give me your thoughts on the relevance of President Obama's trip specifically to Kenya and to Ethiopia. Obviously, AU based in Ethiopia, but isn't that a signal of things to come?
Well, I think firstly I would say, I have a memory of times where in 2006 it was all about China and Africa. So I think under President Obama there's been a much better leveling of the playing field between China and the United States in respect of Africa, which is very healthy for the continent. In terms of Ethiopia, it's absolutely clear, Ethiopia was on the sanctions countries not so long ago for the United States. So to have the president go there and embrace them in the way he did was quite significant. And clearly, Nkosazana Zuma, as president of the AU, it's good to see a South African in those corridors. I would expect she's going to come back to South Africa sooner rather than later, but it was good to see that happen.
You bring us to a pertinent point, mentioning China, Africa, and the story that has long been running from an investment theme. China now, with the uncertainty around their stock market, around the fundamentals of their economy, what knock-on effect does that have for Africa?
I wouldn't overstate the Chinese problems at this point. And China has the...
You think it's a storm in a teacup?
They have the difficulty of growing at 6.8% of a $10 trillion economy. So they're creating 2 South Africas every year still today, even though it's a slowing economy. So a bit tongue-in-cheek, I wouldn't say they're without problems, but I wouldn't overstate them either. Their problems are about this transition, about introducing a capital market and too much margin loans and other issues which are distorting those. But I think there's a lot of confidence if you speak to South Africans invested or exposed significantly to the Chinese stock market, a lot of confidence that this will work out over time and that you will see the likes of Naspers continue to grow through their exposure to Tencent technology. And I think the Chinese are very adept at working through their problems. They know how to put their foot on the brake, they know how to put their foot on the accelerator, and they've been very good at that. For South Africa, we are extremely leveraged, particularly in terms of our currency, to China as the commodity leader, and we're very exposed to the United States equity market. So if the United States equity markets do very well, that will be good for our equity market. But on the other hand, if China does badly on the commodity cycle, it's very bad for us. So, watching those two economies is critical.
Talk to me a little bit about Goldman Sachs's positioning in South Africa and the rest of Africa. Is this something that is going to grow as a portfolio? Will the status quo remain as is?
It's definitely growing. The question is, how fast will it grow? And we like to follow growth. So our interest is aligned with faster growth in Africa, faster growth in South Africa. We would love to double our business.
But it depends on the underlying economic growth.
But we are totally dependent on that. At the moment, the themes of what we are doing reflect the state of the situation. One, the South African situation with a lot of companies under balance sheet pressures, a lot of weak companies being bought by stronger companies, or assets being brought out in order to strengthen balance sheets. A lot of activity around the private equity portfolios in Africa, the IHS of the world, Global, these kind of companies, Equity Bank, very exciting stories of growth. IHS was only possible because MTN did so well in Nigeria, created those towers. All the towers companies are now, getting effectively transitioned in terms of corporate activity in some form or another. So there's a lot of activity, and IHS is a product of that. We raised $2.5 billion for them in the course of this year when they acquired a stake in MTN Nigeria Towers. So that's very significant. And then the third thing is South Africans in particular buying offshore earnings, the likes of Woolworths buying David Jones, which are very significant. And I think that trend is going to be very strong. It's, by the way, not necessarily a bad thing for the country, because we're going to get a lot of foreign dividend inflows into South Africa as South African companies buy these offshore companies. And I think it's going to be a very strong trend.
Colin, thanks so much for your time. I've been chatting to Colin Coleman, the Managing Director of Goldman Sachs Sub-Saharan Africa. You're watching Captains of Industry on CNBC Africa.